Welcome to This Week in Money. I'm Jim Goddard. Today, institutionaladvisors.com Chief Investment Strategist Bob Hoye on the new highs hit by the senior markets. The editor of JugglingDynamite.com, Danielle Park, tells us how investors often end up paying higher fees for placing their money. We'll talk to Bob Hoye right after this.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the Chief Investment Strategist for institutionaladvisors.com. Welcome back to This Week in Money, Bob.
Good to be with you.
Can the senior markets get any higher?
You know, I'm glad you phrased it that way because, as you know, I've been in the game for a very long time, and back in the 60s when, way before computers, you had to do your own charting, and you would buy K&E graph paper, maybe 6 months on the bottom side, and then you've got the vertical. So let's say you're charting the S&P and you're in an uptrend, so you figure now, okay, now how far is it going to go up in the next 6 months? And then you choose a scale that you'd think would accommodate whatever rise happens. And then I remember sharing office with some guys, and out of one office comes a voice says, "Hey, the stock market can't go up any further." And I said, "Why?" He said, "It's at the top of my page." So then now with computers and doing all the charting and graphing and stuff, you know, it always fits on the page. But there's no question that we're at the upper right-hand side of the page, whether you're on paper or on the screen. And so one always gets interested in this being at that corner, because in January we were at the lower left-hand corner of the page. Everybody was scared. I mean, the worst opening to a year ever, and all those kind of horror show stories. But we took the markets as being very oversold, and the key driver then was the collapse in crude oil prices, and that was messing up the credit markets with junk bonds heading south and all that sort of stuff. But we noted the overdone on technicals and the fact that also crude oil can set a low, an important low, somewhere around late December, January, in that window. And then, indeed, that's what happened. The low was at 26. Then it rallied up to 51. But here we are now, as I said, at the upper right-hand corner of the chart for the S&P 500, the Dow, and also the NASDAQ is up there now. So you look around and see what you got. We're getting some momentum, but nothing at all warning now. You take a look at market sentiment, the bulls and bears, the assessment of market letter writers, and it's not excessively bullish. So this stock market rally, at least for the senior indexes, let's mainly focus on the S&P, has further to go. And at this moment, you really can't sort of put a line on the chart and say, hey, it's going to rally to this level or that level, because it's underway. And we also are noting what's working for it, mainly crude oil, which came down to, 39 recently, a week ago. And as it declined, it was giving a number of technical signals, oversold, and then a sequential buy pattern, and it bottomed and has rallied rather good, like something at 3%. So that is a very big plus for the markets, and crude has continued up a little more, helping the precious metals. But I noticed a little while ago that the base metal prices were down a little today. They're not doing so well. But at any rate, the main theme, crude oil and stock markets are very happy today, this week, and will likely remain happy for a number of weeks yet. So then, with this, we're looking at often the transition from August to September. Labor Day weekend can all be positive. You know, you've got a lot of money managers doing on and off vacations during the summer, and then now it's over, and you get back to work, and you get your desk, and you try and imagine that these stocks are cheap and you can buy them, but there is an urge to buy. Also, you've got central bankers around the world are buying stocks for their reserves, which is, well, let's call it a sophisticated insanity that will not end well. So there's a lot of upside going on. Also, they've been buying, well, the European Central Bank has been buying corporate bonds, and the corporate bond market in Europe is not all that big. But there was a bid out last week, and there were not enough bonds offered. So then, of course, that helps out the European corporate bond market, and that in turn helps out the American corporate bond market. So you've had, as I mentioned, in January when the panic selling on crude oil was on, that there was also panic selling of junk bonds. And so those spreads, the difference between the yield for junk and the yield for treasuries got exceptionally wide, out to 20%. And then from that you get a technical rebound. So spreads could start coming in, and then you get into about April, so you figured, okay, now there's a seasonal on this that can take it into June, maybe into July. And indeed, that's what happened. You had this narrowing come in. But in the last 3 weeks, there's been very little narrowing going on. So it's just been trading flat here, which isn't alert and a warning or anything. It's just flat. But if it starts to widen, then it'll certainly get our notice. And the other one would be that, and these of course are working together, junk and crude oil together. So, but in the meantime, let's just enjoy it. Perhaps right through August, and a good seasonal would be the turn into September.
How is natural gas looking compared to crude oil right now? You've got extremely hot weather on the most populated side of the U.S., and so there's an increase in demand for air conditioning. And I just saw the weather forecast for the eastern part of the U.S., and they had a forecast for New York City of 105 degrees. I mean, that would be appalling. And so there'll be, but how much, everybody gets the same weather forecast, so how much is in the market here, I don't know. But let's just take a look at the chart. Yeah, it's recovered. Yeah, earlier in the year, crude was down to, 160, and wow, yeah, and it was rallied up to $3 Natural
a few
gas,
weeks ago, and now it's trading around 260. So it's had a big move on. And let's face it, some of the warm weather is still due to El Nino, although the surge of warm water across the Pacific that is the El Nino, that's ended. And the temperature anomaly there on the ocean has dropped significantly. It's dropping even faster than the big El Nino in 1998. So, but there is a lag from the warming effect ending, which it's ended, and the action. So it just kind of sends a pulse of warm air around the world, and but the source of that heat is now gone cold. So it's likely that one could have a cool winter, in which case the increased heating demands would increase the demand for natural gas. So it's had a good first half on the year, and I think it could trade around. It's corrected here now, maybe a little lower for a little while, and then at some point that would be then discounting the end of the demand for air conditioning, and then it would have some month or so transitioning into then looking for a colder winter.
We'll have more with market historian Bob Hoye next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. We often hear about where institutional investment people are putting their money. Bob, where are you putting your money right now?
Me?
Well, on behalf of your clients.
Oh, yeah. Well, the big thing was, the really exciting thing was end of last November when we looked at the precious metal sector, and you'd had the bear market since 2011. And by the way, also our technical work in 2011 did identify the top for precious metals and also the peak for most commodities in that fateful year. So the work in November was to take a look at the things that have happened at previous important bottoms for the precious metals group. And one would have been to have had gold shares beginning to outperform the gold bullion price. And as we wrote it up in November, that perhaps that could be concluded, in December or January. And that started to work. You had a bottoming there. Also, the other one was that silver would begin to outperform gold, and you had that starting to work. So the idea in November was watch for a couple of benchmarks that say that the cyclical bear market was bottoming, and then the other was to hope it all came into place by January, and indeed it did. And then you had the explosive move rallies out of there. We preferred the gold share side, and silver stocks for that matter, because each of those sets of stocks would outperform the bullion price, which did indeed happen. So, that was the favored position was and expected to get the best return over the foreseeable future was the gold side, because in the other side you were looking at in the fall stock markets very overvalued and vulnerable. They were taking out some supports and stuff like that. So it ended up being a good trade because the S&P side went down and the gold side, when it went up, it really went up. But now it's been happy times. You've had the old Hoye, H-U-I index. Its low back there in the dismal January was 99, and recently was at 268. So that outperformed even the base metal side, which was very good. But this is now fabulous. The trade is very popular, and you've got various big-name personalities I've seen one for $7,000 gold. I've seen another for $5,000. And these are disturbing when prominent names, well, I think this is how they gain their fame, by saying gold's going to go to 10,000 or whatever. And I have no urge to get fame in that manner. But there is no rational method of determining that gold's going to go to 5,000 or 10,000 or whatever. I mean, that's just guesswork, more emotion than research. But you can tell the times when it's going to be favorable, and our method is that with the real price of gold going up, it improves operating margins, people start to make money in the business, and it gets to be friendly again, which has been happening. But nevertheless, it's overdone. We've been very happy with the trade. As a matter of fact, they've been blessed with the trade. And we take some money off the table in here now. A more significant correction is possible. It's starting, I don't know when, maybe in September. So one's got a number of weeks to sort of take some money off the table. And as I say, the trade is extremely popular, and you've got the big names making incredible noises about, I don't know why they go out and say things like that, $7,000 gold. And the $7,000 forecast is based on zero interest rates, and I don't know how you equate that. You had zero interest rates in the 1930s, and sure, gold was moved up from 20 an ounce to 35, but the real price was going up. So when Roosevelt started rigging the price of gold up, he was just doing what the market was doing to the real price anyway. So we're very content to stay with forecasting, month to month and 6 months to 6 months. And on the gold and silver side, now silver has also done what it should have done, which would be to outperform gold on this rally, and it has. It's moved the gold-silver ratio from 80 early in January in a lot, and this now seems to be stabilizing, so the gold-silver ratio can head up. So silver, the metal itself, would be expected to underperform gold. Now, there's one other trick to this, Jim, and that is the gold-silver ratio is kind of it acts like a credit spread. When the ratio goes up, it has a tendency to anticipate things going wrong in the credit markets, and when it comes down, which it did since, it was, as I said, it was 80 at the first of the year, and let's put it this way, we've no major reversal in the gold-silver ratio yet, but if the past is any guide, it could become a little volatile, and that would be a heads-up saying, hey, perhaps there's a change going on. And then if the gold-silver ratio actually does go up, it would signal that there were some problems pending in the credit markets.
Bob, thank you so much for talking to us here on This Week in Money.
Jim, thank you very much. Good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Coming up, Juggling Dynamite blog editor Danielle Park, next on This Week in Money.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to This Week in Money, Danielle.
Good day, Jim.
Danielle, you wrote in your blog Juggling Dynamite that captive money is not smart for investors. Can you maybe explain that?
I was writing about the preoccupation with the financial business, whether they're money managers, advisory services, any kind of investment products, ETF companies, they all do it. They charge a higher fee on money that's put in equities than money that's put in cash or government bonds. So corporate debt, high yield debt too, they charge a higher fee on that. So there's this embedded bias in the business to get more people allocating more of their money towards those supposed growth sides. When because if you want to charge them higher fees, you have to justify that by saying, well, we're charging more because we're going to make you more, and so they put more of the allocation on that side. The reality is that in most people's cases, it's not in their best interest to have an overweight in equity and high yield debt, especially when you're in the midst of, the third blow off top of the bubbles that began in 2000 with all the central bank intervention. We're at the least attractive valuations in a lifetime today, and people are being herded into the risk side by an industry who doesn't disclose this conflict of interest. So I'm saying that even when you're dealing with a portfolio manager who has a fiduciary obligation, not a pure sales side broker-dealer, but someone who has a fiduciary obligation, in those cases, they still typically don't bring to anyone's attention the fact that they make more money if they can talk you into having more of your savings on the risky stuff. And so I say that this is something litigation lawyers are missing when they go to sue, because they're not aware that this bias is so fundamental to the business. So it's also, this sort of fallacy that you hear in the press, and David Rosenberg was writing in the Financial Post this week about, if you think this market is confusing, wait till you see what the smart money is doing, the so-called smart money. And my point is that you'd think that the professional money managers of the world are what people refer to as the smart money, but in fact, because of this inherent bias towards risk products at all costs, at all points in the cycle, and at every valuation point, because they never want to reduce their own fees and they don't want to have a flat rate system that pays them the same low fee whether they're in cash or bonds or stocks, they don't have that kind of a pay grid. Because they have it staggered more heavily towards the risk side, they will never actually be the smart money. They're actually the sort of dumb money, so they're the ones that are the least, they're the most indiscriminate about what they're buying, because their mandate is to buy every day of the week, no matter what, when everyone brings them money. And so I just point out that, there's a lot of companies out there that, in Buffett's famous line, you won't know who's swimming naked till the tide goes out. The fact is that you can't tell how well a manager does in terms of risk management and whether they're worth anything unless you look at how they perform in negative market years. So when all this obsession with chasing performance and looking at whether someone is up in an up market year is actually missing the point entirely. The most reckless and the least disciplined are surfing the wave, usually, to the most extreme in the upcycle, but they're the same people who get, halved when the downturns come. And so the client is left heavily risk exposed, and at the end of the full cycle ends up with no additional benefit or compensation for that. In fact, ends up often back where they started many years before, and having less time to make back the losses. So this is not investment genius, and the smart money is the dumb money. And I say that the majority of investment capital today is held in these kind of captive, perpetually allocated funds and products, and so where the preoccupation is on keeping the management fees as high as possible, not on managing the risk. And investors need to be really aware of that before they just buy in.
What about the people who feel they have to do something no matter what?
Yeah, well, that is the enemy of prudence and wisdom, because it's right now we're living in a world where central banks have done everything in their power to herd us towards risk so that they can bail out the banks. So the banks that were overly aggressive, full of great hubris, reckless, blew themselves up in 2008 with the global economy. The central banks of the world, who are not the government, who seek to serve and assist private banks in the world, that's their mandate and job, they basically have done everything in their power to drive everyone else into those risky assets so that banks can raise cash and sell products and generate fees and try and get their capital ratios back up. So the fact is that if you're taking that bait, if you're saying, well, I have no choice, then you're going to get what you deserve, which is probably really significant capital losses. And even though this cycle has gone on probably 3 years longer than it would have without the QE continually pumping markets, the full cycle has not yet completed. So, they talk, for example, and this is another point I on the similar theme that we started on, is that there's many articles of late about how bizarre bond markets in the world have become because central banks, again, have been, buying bonds off of banks and basically bidding up the value so that yields crash lower, and that they hope will drive more people and pensions and pools of capital towards risk. It also gives banks, when banks get cash for the bonds on their books, they then typically go and do reckless things with that cash, which drives up the price of assets further on the risk side. So everyone's focused on the insanity of a world where many $1 trillion of bonds, something like 13 trillion globally today, are yielding 0 or negative, which people can't even get their mind around. A bond, in other words, you loan someone the money and they don't pay you back with interest. They pay you back less than you loaned them over the term. And we're talking terms that are 10, 15, 20, 30 years in length in some countries. They are literally giving back less than you loaned them in the first place. That's the reality of negative rates. And it's having a catastrophic effect, of course, in the real world in terms of trying to save, in trying to fix liabilities with future obligations, and trying to manage life insurance companies and pension firms. All this stuff is just wreaking havoc on anything in the real world and for real savers. And all that is a valid concern. But what I find really ironic is that the industry, again, because they have this bias against buying fixed income instruments and anything that doesn't generate large fees for them, they fixate on what's going on in government bond markets. For example, in Europe, not in North America right now, we don't have yet 0 or negative rates, but they grab that fact from other countries and they bring it home to say, hey, see, it makes no sense to be owning bonds. How lovely. The fact of the matter is, though, that stocks have absolutely no maturity date or any prescribed responsibility to pay you income in law, whereas bonds are these contractual obligations. They have a maturity date. Typically, they have to give you back capital unless the entity goes bankrupt. And they have to give it back to you on a certain date. That's all prescribed, and they have to pay you interest at the stated rate every 6 months. That's part of the contract. When you come to a stock, a common share, companies there's no maturity date. So you buy it on the hopes it'll go up before you need to sell it. That's all that you do. It's a speculation on the prospects of hoping that the thing will go up over time. Now, while you're buying things at, as I say, these historic highs, and whenever we've had valuations like this in history, you typically have at least 7 to 10 years from there where prices are either flat or negative from that point. It took 25 years from the peak in 1929 before people were able to get back to principal that they held in the stock market in 1929. And I say, 29, it took 25 years, but most of the people that were holding then had long since sold because they had to, they needed cash, or they had margin calls, or they died, or, so it's a preposterous time horizon to think that, people can just hold indefinitely to hopefully get their money back someday. And I think that the industry, again, doesn't make that distinction and point out that there's no maturity or guaranteed payments on stocks because they're in the business of trying to herd people into it, just like central banks. So you really have to be so careful because we live in a world where the message is constantly being shaped by the messenger. So whether it is the risk-selling finance business who's trying to convince everyone to buy products off them, whether it's data reporting agencies like the Bank of International Settlements that's, reporting jobs, growth numbers, and they turn out to be, estimates that are significantly revised lower after the fact, or GDP numbers which come out and then 2 years later are dramatically lowered in retrospect. Like, all this data that comes out as a bullish message ends up getting revised lower, and we've seen that now for the past decade. So what I'm saying is that the prices that we're seeing in asset prices, whether it be real estate, which is completely off the deep end in many areas, whether it be in stocks and high-yield debt, all these things are going to be subject to the powers of mean reversion eventually. When truth comes out, when reality is repriced, when we realize that they're trading at these insane multiples, that means people aren't investing, they're speculating, and they're likely to get negative returns for the next decade from here, all of that will come back to haunt the people who are blindly allocating their money to these things today.
We'll have more with Danielle Park next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Danielle Park, editor of the popular blog Juggling Dynamite. Danielle, are you nervous that the Bank of Canada Governor Stephen Poloz keeps talking about negative interest rates? A possibility of them anyway?
Well, I wouldn't say I'm nervous. I would say that there's only so many tools in this central bank kit. They all went to the same schools. They all studied from the same textbooks. They only have the same idea, which in a nutshell is add more debt and stir. And they've been doing that for 30 years. And because of that, we are now in an economy where households and businesses are emaciated with, very little actual cash and tons of debt and overinflated assets. And so they've already cut rates down to the bone. They've been doing QE, in various countries around the world for the past 6 years. So they're really down to now what can we do, because the global economy is turned down again. The last time the U.S., the largest economy in the world, the last time they clocked anything like 2.5% GDP growth was actually in 2010. And we've been coming down from then as asset prices have gone higher. Revenue's been rolling over since about 2011, even as gimmicks and stock buybacks have driven prices of stocks higher. There's been no underpinning of fundamentals for that. And so now that you're getting them sort of to the very, very end of any ideas they can come up with, you saw places like Japan and the ECB try this negative rate phenomenon, but in fact you see it's backfiring, Jim. And again, common sense would dictate that it would. But in theory, of course, they thought that if they pushed rates negative, you were literally paying people to borrow and spend, and therefore they assumed that people would borrow and spend, and that they would, drive more consumption and buoy up the world economy. This is the nonsensical parlance that comes out of their mouth every time they have a press conference. But the fact of the matter is that it's having the opposite effect. So people, of course, are saving more because they're looking at their pool of money that they've got set aside for future needs and spending and saying, oh my goodness, it's earning zero. God forbid it's earning negative returns, which means that I have to actually save more today to have the same amount of spending capacity in the future. And so they're noticing that it's backfiring all over the world. So will they try it in North America? I don't think they're keen. I believe Yellen and Poloz at their face to say, they would like to avoid that. They would like to not try that last desperate trick in the book. The fact of the matter is, though, as the economy slows and as people turn to them and think of them as these monetary magicians, which was never a reality. It was always, as I say, just add debt and stir, and that looks all great as the leverage is increasing. But once the leverage starts coming out, it accelerates to the downside, like on steroids, the steroids being the excessive debt in the world. So I think that they've got that sort of one hammer left in the kit, and they're thinking, oh my God, I hope we don't have to use that. But the truth is that if the world economy was accelerating and improving over the past 6 years, they wouldn't have had to get more and more desperate with these policies. So the fact that we keep degrading further down the rabbit hole towards, financial destruction, it just tells you how rough things are and how desperate these monetary folks have become.
Do negative rates mean that we're closer to having our bank accounts skimmed like happened in Cyprus?
Well, that's a whole other thing. So the question is that if we get into another massive credit bubble collapse, as we've been sort of edging towards, and there's every reason we should have such an outcome because we had it in 2008 and the world has something like 60 trillion more debt and probably, a couple of times that in derivatives now added to the system in the last, say, 8 years. So there's every reason to think we're going to see another major squeeze in terms of credit in the world. Places like Deutsche Bank are in disaster in Europe, one of the biggest financial institutions in the world with credit default swap relationships and all sorts of intertwined dealings with all the major institutions in the world. So you see, if you have a Deutsche Bank collapse, which is becoming ever more imminent, that could have knockoff effects around the world banking system again. So the issue becomes, what is the response? What is the policy response next time? So the way that banks are typically set up is that they first start to blow through their own capital buffers, the investors on the equity, the preferred share side, the bonds and debentures. Those are all supposed to lose principal before we get anywhere near customer deposits. To the extent that that buffer is large enough to absorb the liabilities and losses, that's the question. Because if it is sufficient, and they've been bragging lately that they've made banks raise their capital buffers and that should protect deposit holders, if it is sufficient, then by all means the bank investors would all lose money, but the deposit holders should be made whole. In the real world, though, we don't know exactly how many liabilities are going to be outstanding in this kind of a pressure cooker. And the other problem is that many banks have, like in the omnibus spending bill last December, they pushed through this in the U.S., for example, a provision that basically undid the entire efforts of the Dodd-Frank bill to protect consumers and bank customers from the levered bets of their institutions. They put through something saying that credit derivative swaps would get first dibs on assets. The derivative holders would have first dibs on assets ahead of the queue. So that puts everyone at risk again, because that's like an MF Global scenario, if you remember, Jim, a few years ago, where J.P. Morgan was holding the rehypothecated assets, which were actually client assets that were given to J.P. Morgan, MF Global client assets that were given to J.P. Morgan as collateral for money that MF Global had borrowed. Believe it or not, they were allowed to use their client deposits as collateral for money they'd borrowed from J.P. Morgan. And when those bets went bad, J.P. Morgan just held the client assets and the clients didn't get their money back. So that kind of stuff is going on in the finance sector, and it is a concern because we're never sure exactly where, when the music stops, who's holding what. And so I would never say that we're not anywhere near the risk of bail-ins. I would say that it depends on the institution. Theoretically, again, there should be hard returns divided between institutions so that if your Canadian bank is holding your deposits, then and they get into any sort of insolvency issue, there should be these levels of capital for them to blow through first before they get anywhere near deposits. And the Canadian banks have relatively higher buffers than many in the world. Now, the risks are if they've done any of these sort of backroom deals that purport to have preference or give the certain derivatives holders preferential treatment over bank assets. And to the extent that those have been put in place, I don't think we know where all the bodies are buried in that stuff because they've been incredibly secretive about the deals they've struck. And we know that finance is incredibly self-centered and focused on their own profits and liquidity. And now, for example, there's talk about Deutsche Bank has to be bailed out by the taxpayer, of course, right? Every time the purview of collapse comes back, the first thing the bank executives do is go to the government and say, well, you're going to have to bail us out or else. And I'm really hopeful that at this point we allow the or else. In other words, we allow the bankers and the bank investors to take their due hits as they must, because unless and until that happens, our financial system will never get recalibrated, will never get back to a stronger framework in support of the real economy. So I think, this election cycle in the U.S. is setting up to be quite a mess, as you've seen, and whether it is a Trump, which I think will be a catastrophic event for markets. On the one hand, that's what we need to shake out a lot of the status quo players and risky behavior that's been going on. But on the other hand, for all sorts of reasons, it's hard to wish that to happen. But anyway, I think we're coming to another great period of disruption, and we're going to find out exactly how all these chips fall.
One indication that perhaps the world economy is going into the tank is that thousands of construction workers, mostly from Asia and Indonesia, are trapped in Saudi Arabia. Can you maybe tell us about that?
Well, it's the same of really that sector all over the world. If you think about pockets in the Canadian West where, they were huge oil centers in the past, 6 or 7 years, where everyone flocked out there and everyone was getting great jobs and buying houses and, being paid more than the average wage in the country. And then you have the collapse that happened since 2014 in that industry where, layoffs continue and the price of oil is still bouncing around $40 a barrel. You see that there's a lot of people left out of work, and then they're trying to, at least in places like in Australia and Canada, they're trying to sell their properties, their houses that they bought on big mortgages, to a group of people, a population that is increasingly stranded and without work and needing to leave. So everybody's trying to sell onto a market where everyone is selling at the same time, and very few people have any reason to buy in that area. And in Saudi Arabia, in this particular article you're mentioning, it's not a question of housing, it's a question of they just were basically there, whether it be actually in the energy sector, whether it be in the huge building boom that was going on in Saudi Arabia in many big cities, building huge skyscrapers, all of it with this money that was coming out of, bubbling asset prices in the past few years as commodities went through the roof on QE. And so, again, people factor in this assumption of continued revenue at that record pace. Everyone levers up, builds like crazy, and then all of a sudden the customers vanish, the cash flow dries up, and the debt payments still need to be paid. So you've got a lot of those pockets of population around the world, foreign laborers that had migrated from other areas, all looking, all in many cases owed money from companies, construction or otherwise, that have shut down, and they're not paying them their last wages, so they have no money to go back home. They're like left in encampments where there's not enough medical supplies or food. I mean, it's quite a disaster, and I point out that that everyone thinks that the boom phase is so amazing and that everyone's getting rich, but in reality, it's just risk exposing the entire populace and structure, because elevated pricing in the end comes crashing down, and people thought they had accumulated vanishes, and then they're left with not cash flow or jobs or wealth, and it creates great havoc in the world. So, I think we have to get the central banks of the world back behind some kind of a cage so that they're not in a position to inflict this kind of disaster on the world going forward. And again, I'm hopeful that as this blow-up continues to cause all sorts of pressures politically, financially, everywhere, that people will finally capitulate as they did in the 1930s. Even after the collapse of 29, Herbert Hoover was still trying to work with the banks, and nobody was requiring anyone's resignation or prosecution or, repatriating of ill-gotten proceeds. None of that was happening after 29 until we got into the Pecora Commission and the revelation to the population of all the corrupt things that had gone on. And then, because the public was hurting so badly, the politicians had no option but to bring in these restraints and round up offenders and make a public showing of it, break up the banks and that sort of thing. So anyway, I think we could be headed in that direction again, and all of these factors are really just building that pressure that is like a pressure cooker and eventually blows, and that's when you finally get some reforms.
Danielle, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Danielle Park, president of Venable Park Investment Council Incorporated. Her website is jugglingdynamite.com. That wraps up our show for this week. We'd like to thank our guests Bob Hoye and Danielle Park, and thank you for listening. Questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.